Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at the latest with regards to commodity prices. We'll also have a look at the latest US growth and inflation numbers and what that implies for monetary policy. We'll look at a recent change in leadership in the US market. And finally, we'll have a look at PPI inflation in South Africa. We're going to start off with commodities. Despite an uncertain start to the negotiations between the US and Iran, oil is currently trading roughly in line with pre-war levels. Brent is just a bit below and WTI is just a bit above where it was before the start of the war. It is important to note, however, that gasoline prices in the US and in general pump prices across the globe are not coming down as rapidly. And that's due to primarily refining margins being still quite high. So we've landed up with a sizable decline in crude prices, but refining margins are still elevated due to still supply constraints in the Middle East and refining capacity in Russia being taken out. And the net result of that is that gasoline and diesel prices have been coming down, but not at the same pace that crude prices are coming down. And that implies that inflation is not likely to come down by as much as you would think if you were just looking at crude prices. Having a look at other commodities, there's been a pretty sizable decline across a broad basket of commodities month to date. So it's not just that crude has come down 26% over the past month, but in addition to that, if you have a look, platinum has been smacked down about 17%, nickel's down 12%, aluminium's down 13%. There's been a broad-based decline in commodities across the globe. And we think that there's three primary reasons for that over the past month. Firstly, as we've spoken about over the past couple of weeks, there's been increasing indications of a slowdown in China. The latest indication is that the deficit in China has decreased. It would appear there's early evidence that the Chinese government is pursuing austerity. So despite the fact that retail sales have been weak and industrial production has been weak, it looks like there's no fiscal stimulus at all. In fact, quite the contrary, there's some form of austerity at play, and that would be hanging over commodities. In addition, despite the fact that the war appears to have come to an end, although again that's a bit uncertain at the moment, and there's been broad-based risk on trade, the dollar in fact has been quite strong too, and that's quite unusual. And strength in the dollar is clearly unhelpful for commodities too. So there's signs of weakness in China. The dollar has strengthened, and the third reason is a new head at the Fed. Ever since Walsh has been nominated to head up the Fed, we've seen the sort of trades that would do well in a dollar debasement environment do poorly. The dollar has strengthened, we mentioned that as one, but we've also seen cryptocurrencies take a hit, a sizable hit over the past few months. In fact, the total market cap of all cryptocurrencies now is about half of where it was in October last year. And there's other broad signs that the dollar debasement theory has taken a bit of a hit since Walsh has been nominated. And with that, hard assets have taken a knock, along with them commodity prices. So there's those three primary reasons for why we think we're seeing a broad-based weakening of commodity prices over the past month or so. Just switching to the US, while there are these concerns about the Chinese economy, US growth has been revised up, and now Q1 growth looks like it was running above 2%. And if you look at the latest indicators for Q2 growth, those numbers are running even higher at 2.5%. So it looks like the US economy is starting to run hot. And at the same time, core PCE inflation has picked up again. It's now running at 3.4%. That was in line with the consensus, but slightly above last month's reading of 3.3%. And if you look at the 3-month rate, annualized, that number is running at 3.5%. And given the sizable month-on-month increases that we've seen so far, it's going to take some time for core PCE inflation to get to 2%, even if month-on-month inflation normalizes. So even with the fall in fuel prices that we're seeing, and ultimately surely there'll be some pass on to core PCE inflation, it's going to take a while before the inflation series that the Fed concerns itself with gets to 2%. So now you've got a situation where growth is accelerating and still quite strong. Core PCE inflation is running hot. The net combination of those is that Fed cuts seem very unlikely anytime soon, and there is a likelihood of a hike by year end. Even so, markets appear to be pretty strong, and part of the reason for that is that we're seeing very high margins, not just in the US, across the globe, and not just in tech, across a range of sectors. Operating margins are very high, and as we've seen in the US, earnings as a percentage of GDP are very high too, close to record high levels. So it's an environment where earnings have done very well, and if you look at margins in the US have gone up. I think that's widely recognized, but they've also gone up in Europe, and they've absolutely surged in Japan. And so we're sitting in an environment which has been very helpful for equities. Corporates are doing very well. Despite margins being pretty elevated, we have seen sizable divergence in the equity market and a pullback, for example, in software and services. Now, that's in part because AI is viewed as a substitute, a cheaper substitute from software and services. Perhaps you can create all the software in-house at a very cheap rate, given the development of AI. But more broadly, if you have a look at the equal weighted S&P 500 versus the market cap S&P 500, we're seeing a divergence. So S&P 500 equal weighted has outperformed month to date and year to date. And it suggests that some of the issues sit with the larger names, and the smaller names are starting to outperform. It's a shift in market leadership. And we're going to be keeping a very close eye on this. We'll give more detail as the reporting season comes through over the next couple of weeks. And finally, in South Africa, PPI inflation for SA came out last week. It was an ugly read, 7.8% year on year. PPI inflation is a key leading indicator for CPI inflation, suggesting that there is still some upside ahead for CPI inflation. That's how we would normally read it. But just bear in mind, given the recent fall in crude prices, that should in part offset some of the increase from PPI inflation. So it's not clear that it would neatly translate to an increase in CPI in the way that it would have done before. But even so, it suggests that there is still some uncertainty around CPI inflation. And this is going to be an area of focus for us and, of course, the SARB over the coming few months. And we'll end it there this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.